Market indicators. 10 stocks to consider, with reasons and DYOR note. This video is a research-only market scan, not financial advice. As of August 20th, 2026, markets were dealing with mixed signals. Higher long-term treasury yields, volatile oil, a strong move in Bitcoin, sector rotation, pressure in some AI hardware and software names, and strength in parts of healthcare, gold, industrials, and infrastructure. When markets are mixed, the goal is not to predict perfectly. The goal is to build a watch list, understand why each company matters, and wait for risk-managed entry points. The first indicators to watch are treasury yields, the dollar, oil prices, gold, market breadth, and earnings revisions. Rising yields can pressure growth stocks because future earnings are discounted more heavily. A weaker dollar can help commodities and multinational companies. Higher oil can lift energy but pressure consumers. Gold strength can signal inflation concern or safety demand. Market breadth tells us whether gains are broad or concentrated. Earnings revisions tell us whether analysts are becoming more or less confident. The first 5 stocks to consider for research are NVIDIA, Broadcom, Microsoft, Amazon, and Alphabet. NVIDIA remains central to AI compute. Broadcom benefits from AI networking and custom silicon. Microsoft combines cloud, enterprise software, and AI distribution. Amazon has AWS, advertising, logistics, and marketplace scale. Alphabet has search, YouTube, cloud, and long-term optionality in areas like autonomous vehicles. The risk across this group is valuation and expectations. If AI spending slows or margins disappoint, the stocks can correct sharply. The next 5 names are Eli Lilly, GE Vernova, Micron, Union Pacific, and JP Morgan Chase. Eli Lilly gives exposure to powerful healthcare themes. GE Vernova connects to power generation, grid demand, and the AI electricity bottleneck. Micron is tied to memory demand, which can be cyclical but important for AI infrastructure. Union Pacific offers transportation exposure if the industrial economy improves. JP Morgan provides a high-quality financial benchmark with scale, deposits, and credit discipline. Each has risks: healthcare regulation, industrial execution, semiconductor cycles, freight weakness, and credit losses. A good watch list is not a command to buy. It is a starting point. For each stock, review revenue growth, earnings growth, free cash flow, debt, valuation, analyst expectations, and technical trend. Ask whether the company has a durable advantage and whether the current price already reflects the good news. Then use position sizing. Even great companies can be poor investments at the wrong price. Here is the DYOR note. Do your own research before taking any action. This video is not personal financial advice, and it does not know your income, goals, debts, time horizon, taxes, or risk tolerance. A stock can be a good business and still fall. A strong theme can become overcrowded. A cheap stock can stay cheap. Research first, manage risk second, and only then consider position size. A market indicator is useful only when it helps decision-making. If 10 indicators disagree, the message is not confusion, the message is caution. In August 20th, 26, investors were watching yields, oil, gold, crypto, earnings, and sector rotation, because each one gave a different clue about risk appetite. For growth stocks, interest rates matter. A company like NVIDIA or Microsoft may have strong fundamentals, but if long-term yields rise sharply, investors can become less willing to pay high multiples for future earnings. That does not destroy the business. It changes the price investors are willing to pay. For industrial and infrastructure names, the question is whether demand is durable. GE Vernova, for example, connects to power demand, grid upgrades, and data center electricity needs. But investors still need to check backlog quality, margins, execution risk, and valuation. For healthcare, Eli Lilly shows how innovation can create a powerful growth story. But healthcare stocks also face trial risk, regulation, pricing pressure, and competition. A strong drug pipeline is valuable, but investors must keep watching evidence, approvals, manufacturing capacity, and reimbursement. For financials like JP Morgan, the key indicators are credit quality, deposit costs, loan growth, capital requirements, and the yield curve. Banks can benefit from scale and higher rates, but they can also suffer if credit losses rise or the economy slows. The safest way to use a 10-stock list is to build a research dashboard. Track earnings dates, revenue growth, margin trends, debt, valuation, analyst revisions, chart support levels, and news catalysts. Then decide whether each stock belongs in a long-term portfolio, a trading watch list, or no action at all. When reviewing these 10 stocks, it helps to separate business quality from stock price. A company can be excellent and still expensive. Another company can look cheap because the market expects trouble. The investor's job is to compare quality, growth, risk, and valuation together. For AI-related names like NVIDIA, Broadcom, Microsoft, Amazon, Alphabet, and Micron, watch capital spending trends. If large cloud companies keep investing heavily in data centers, suppliers may benefit. If spending slows, expectations can reset. AI is a powerful theme, but themes become dangerous when prices assume perfection. For GE Vernova, the research question is power demand. Data centers, electrification, grid upgrades, and industrial activity all need energy infrastructure. But investors should examine execution, margins, backlog, and customer concentration. Infrastructure demand can be strong while individual projects remain difficult. For Eli Lilly, the key is whether growth remains supported by real medical demand, manufacturing scale, trial results, and payer acceptance. Healthcare innovation can create long runways, but pricing pressure and competition are always part of the risk. For Union Pacific and JP Morgan, the watch list becomes more economic. Railroads reflect industrial activity and freight demand. Banks reflect credit, rates, deposits, and consumer strength. These names can help balance a portfolio that otherwise leans too heavily toward technology. A careful investor can turn this list into a process. Build a watch price, decide what evidence would confirm the thesis, decide what evidence would break the thesis, and write down the risk before buying. That discipline is more valuable than any single ticker idea. The 10 stocks to consider for further research are NVIDIA, Broadcom, Microsoft, Amazon, Alphabet, Eli Lilly, GE Vernova, Micron, Union Pacific, and JP Morgan Chase. The reasons are AI infrastructure, cloud and platform strength, healthcare innovation, power demand, memory cycles, transportation exposure, and financial quality. But the market indicators are mixed and discipline matters. DYOR. This is education only, not financial advice.